Hello guys, welcome to the session today. I'm just seeing you guys joining the room here, so welcome. I'll give you guys another couple of minutes to join. As we are waiting for people to come in, just to say on the right hand side there, and I know it's on its side, so if you tip your head a little bit you'll see it, my email address there is becky@tradewithufos.com. So as we go through the session today, if you have questions afterwards or something you want to check with me, no problem, you can email me, becky@tradewithufos.com. There's actually a better way, I think, to get a hold of me, and that is at the tradewithufos.com/Becky, that link there. Now, the reason for that, I'll just show you real quick. The reason for that is if you come to this, you can create a free membership just at the top here from that link, and then when you come down, you can ask a question in a public setting once you've got your free membership. Now, the reason that asking questions in a public setting, to me, I think is a good thing, is because it might be that the questions that you're going to have for me, other people have already asked, so you can find the answer already down here. Or it might be that the question you're about to ask, somebody else will have that question later on, so you're kind of helping them out by asking that question as well. So it's good for everybody if those questions are asked as publicly as possible, so that I can answer them publicly and you guys all get the answer, not just one-on-one. But I do understand if you want to email me, you are welcome to do that as well. By the way, to sign up for the free membership, all you need to do is put in your name, email address, click I'm not a robot, and just follow the steps from there. You'll also get discounts sent to you every now and then, and recordings of our YouTube sessions. Also, you can use these links. So in this one, my name is at the end, so tradewithufos.com/Becky, to be able to come and book directly with us if you want one-on-one coaching. That's true of the others as well. So if it was Andrew, if it was tradewithufos.com/Andrew, then you would be able to book directly with Andrew, and so on. So hopefully that makes sense. So coming back to this page here, I just need to make sure we cover the disclaimers. So those are being highlighted there at the top. Important that you read them if you want to come back later and read them or something, or read them now. It is important that you guys understand the legalities, but also just in general that, of course, when we do these kind of sessions, we're giving you a demonstration as to how you could use the technology, how you could use the product. It might be that you have different risk management rules, you trade different markets. So it's not to say just because we place a trade that should be something that you do. It's just to give you a demonstration, and then you can decide based on your rules and your trade plan whether or not it suits that. Okay, so cracking on in terms of the session, obviously just to say we're doing swing shots. So hopefully clue is in the name. We are doing some swing trading today. We'll also sometimes do a little bit of position trading. So obviously those two are very, very linked. But good thing is the way that we do the process, the methodology start to finish, can be used on pretty much any time frame. So you would just apply it on smaller time frames in order to make this a day trade, or you would apply it on bigger time frames in order to make the methodology an investment or a much longer term thing. So again, we're going to be doing swing position trading, but you can apply it across if you'd like to. So just coming across here to look at, for those that might have been in the session that we last took, just to go over that trade that we put on last time and see whether or not it triggered and what happened. So these were the UFOs aren't showing here, sorry. There we go. So this was the UFO that we took down here. Our entry price was 0.6938 and our stop price was 0.6925. Now, as we can see, we put this trade on, but we didn't quite get to it. Price didn't come back and get us in. We put this trade on. Actually, we would have put the trade on around about then. So from this point, obviously, price has not come back and triggered our entry. So what we need to figure out is this a trade that we still want to take? Is it still a valid trade? This was the Canadian versus the Swiss franc, and we used a 144-minute chart as our entry time frame, as the time frame that we were using to use the UFOs to place the trade. By the way, you guys let me know. I might be assuming some things here that you know the technology or that you've been in sessions before. If you're completely new to the methodology, completely new to the technology, just let me know, tell me. I can then explain things a little bit better, a little bit slower, or go into more depth. If you've been doing it ages, also let me know, and then I can speed things up. So the more you let me know as to where you're at, the best I can make sure that I present it to you guys so that you understand it as best you can. So this was the trade that we had last time, and we put it on last time because we had a confirmed upwards climate, probability to the upside. That was on our weekly chart. And so we looked to the 144 minute to place the trade. Now, in terms of auto climate, we still have a confirmed upwards climate probability to the upside. So it would still potentially be something we're looking to do to go long. Now, in terms of exactly where we would go long, we would be looking at our EMA value here to help us out. So don't worry, I'm going to go through the entire methodology, hopefully with a different example, if we can find a good opportunity. So don't worry if I'm skipping through this a little bit quickly. I'm seeing there from SB that you're completely new. So no problem. As I said, we'll go through the methodology start to finish with something else. So hopefully that will put this into context to make it make a bit more sense. So with this here, we have our EMA value on the weekly chart as 0.6965. Let's just round that down there. So 0.6965 would be, I guess, round about here-ish, something like that, or maybe, oh no, it'd be about here-ish. So at the moment, our EMA value, for those of you that do know the methodology, you'll notice that our EMA value is not coinciding with our UFO right here. Now, saying that, we do a bit of anticipation. If price were to fall down, especially if it were to fall down quickly, it might not change the auto climate. If it comes down, the EMA value, moving average, will move with price. And so there's a possibility that that EMA value will coincide with that UFO if price was to fall from here to enter this UFO. Obviously, at the moment, we don't know that's going to happen. So the best thing to do is to set an alert so that before you get triggered into this trade, you make sure that everything is lining up the way it should for you to get into it. So for the time being, I'm just going to leave the lines on the chart just so we've got a reference for it, and we can maybe come back next time and see what happened with that trade, whether we would have cancelled it or not. Just to say, again, if things don't add up, well, by the time the price would come into the UFO, if the EMA is not lining up with that UFO, we would cancel that trade. If it does line up with the UFO and we've still got our climate on our side, then we would take the trade. So again, we're making decisions on whether or not we cancel or take a trade based on what the price is telling us, what the technology is telling us. So I'm going to come back to, or I'm going to come to a scanner that we have here on TradeStation. Now, before I explain the scanner and what we're doing, I'm just going to break down a little bit what the whole point of this is, what we're trying to achieve here. So when we're trading, the first thing we want to know is, should I buy, sell, or do nothing? That's the first question we should be answering and asking ourselves, or first question we should be answering. Now, doing nothing, although that sounds like it's a pointless thing to do, sometimes it's the best thing to do. We'd rather not place a trade just for the sake of placing one and then end up losing money. Better to have not placed that trade. So we want probabilities to tell us, what should I be doing? Do I have probabilities to buy, probabilities to sell, or do I not have enough probabilities to do anything so that I can at least save my time and save my capital? That's not to say if we do have probabilities for buy and sell that it's a dead cert that it's going to work out. We're still going to manage our risk, and we're still going to make sure that we're trying to get in and out at good places. But the first thing we should know is, should we be buying or selling? Should we look to go long? Should we look to go short, or do nothing? So to answer that question, we use our auto climate. So if I come back to the chart here, that's what auto climate here is for. That's what these dots are. If it's a thick blue dot like we have in this example, then we have probability to the upside, meaning we're going to go looking for long opportunities. We're going to look to buy. If it's a thick red dot, say one of these, then we would be looking to go short, looking to sell. We've got probabilities there to the downside. It might be a thin dot of either color, like for example these ones. Might be a little bit harder to see, but I guess that's the point. They show us that we have no probability either side. It doesn't matter the color. If it's a thin dot, we don't have enough probabilities, and that's where the question would be answered, by doing nothing. We don't have probabilities either side, so why would we go placing trades, risking money, if we don't have probabilities? So we use the auto climate to help answer that question. Do I go long, short, or do nothing? In this particular example, thick blue dot, that would be telling us we look to go long. Now, the second question, once we've figured out whether or not we should be going long or short or do nothing, if we're going to go long or short, it's, if I'm long, where? If short, where? Just because it's a good idea to go long, meaning I buy to get into the trade, that doesn't mean that just pressing buy right now, whatever the price is right now, is going to be the best thing to do. Chances are, if I do that, I'm getting in the middle of nowhere. My risk might be greater than it needs to be. My profit potential might be smaller than it needs to be. And my probabilities are unlikely to be in the best place. Same if I'm going short. I'm not just going to click sell wherever price happens to be right now. So I want to know, if I'm going to buy, where should I be buying it to increase my probability, keep my risk managed, increase my profit potential? If I'm going to sell, where am I going to sell for the same things? So we're going to look on this scanner here to essentially what the scanner is showing us is where we have question 1 already answered. That's not to say we're going to go and place trades. It might not work out if the second question is not answered properly. But this scanner here just saves us time rather than going through each individual market and looking at that auto climate. We use the scanner to make this a quicker process. So if you've never seen scanners before, this can look a little bit weird. You've got different colors and different numbers and different flashing yellow things going on. So I'll just break it down and explain it a little bit here. So let's just take this top example here. So on daily climates on the pound versus the US dollar. Now we're going to look on the the right hand side here, and we want to look for the ones that have yellow boxes. Why? Because the yellow boxes are telling us that we have near opportunities, that we could be likely to get into a trade sooner rather than later. So again, it's a more efficient use of our time to know that. Now you might notice some of them are yellow boxes and they'll say near sensible long or near sensible short. Some of them will say near hopeful long or near hopeful short. Now as traders, we don't want to be hopeful. We want to be sensible. Sensible implies probability. Sensible implies methodology. Hopeful implies winging it. We don't want to wing it. We want to have as many probabilities on our side as possible. So we are going to hone in on the ones that say near sensible and then long or short. We don't care whether we buy or sell, as long as we have the probabilities to the one that we're going to be doing. Now it will tell us long or short, that's helpful, but there's one extra component here that we need to be looking at, and that's this column here. Let me just change the color on that to highlight that a bit easier. This column here. So you'll notice in this column here, we have blue, red, and then like a grayed out non-color kind of situation. It doesn't matter what the color is, because again, we don't care if we're going to go long or short. It's wherever we have the probabilities. But what we want to make sure is, if it's saying near sensible long, that it is showing us a color there. It's showing us a blue color. Because what that's telling us is that it's a confirmed fund, meaning we have probabilities on our side. If it's a grey box, this is telling us it's unconfirmed, less probabilities. So we want to ignore them. So even if we have a near opportunity, if it's not a near opportunity with high probabilities in it, we don't want to be even looking at them. So we need these two things to happen. We need a near sensible long or short, and we want to make sure that that coincides with the color that it should be. So in this case, it's going to be a near sensible long. So we'll look at this. We'll go on and we'll look at the pound versus the US dollar. Daily climate there for our bigger time frame that we're using to decide whether or not we go long or short. That's what we use our auto climate on. Now again, the scanner has done a bit of work for us there to hone that in, so we didn't have to go and look through a whole bunch of currency pairs before we decided that we have a potential opportunity here on the pound dollar. So hopefully that makes sense. For those of you that are new, let me know if it doesn't make sense. I can maybe re-explain it or explain it again. If you've done it a while and it does make sense, also let me know so I can figure out where you guys are at and again what I might need to do more or less. So let's go and look at the pound dollar in the meantime, and again ask me questions, let me know your questions as we go. So I'm just going to put in pound dollar on each of my charts here, and I'm also going to make sure that we're looking at the right time frame. So we were looking at a daily climate there. So if we have a daily climate on the left hand side, then that means we want to have a 55-minute chart on the right hand side. Now that's just the time frames that we use to go with each other. You could perfectly well use a 60-minute chart or a different time frame chart, whatever you're used to using, and that would be fine. We use these odd time frames for that exact reason. They're slightly off. So when we're trying to get into the trade and figure out where we're going to buy or sell, we want to have a slight edge over what the masses are using, which is why we use these slightly off time frames that are actually coinciding with Fibonacci numbers. But if you can't see a 55-minute chart and you only have 60 minutes as an option, that's also fine. So you can use 60 minutes there for the right-hand side. So we have our confirmed upwards climate, probability to the upside, meaning we should be looking to go long. But should we just go long anywhere? No, we should be looking for the best places to do that. That's what we use the second bit of technology for, are UFOs. So UFOs doesn't just, it's not just called UFOs because they look like little flying saucers, unidentified flying objects. They're called UFOs. It's an acronym there for unfilled orders, UFO. Now, what are unfilled orders? Essentially, buying and selling in the markets, you have buy orders and you have sell orders. So if you have unfilled orders, and in the case of our green UFOs, we mean unfilled buy orders, a whole bunch of buy orders that are sat waiting there. Well, if price comes down and hits that general area, hits that stack of orders, and lots of buying comes into the market, what do we think happens? Lots of buying comes into the market. You guys let me know in the chat. You've been a bit quiet today, so I'm going to try and make you answer some questions. What do you reckon happens? We've got a whole bunch of buying coming into the market. There we go. Bullish. Thank you, Cliff. Market is likely to go up because lots of buy orders come into the market. So the UFOs are highlighting to us, they're analysing a whole bunch of data, not just structure of price, but volume, upticks versus downticks, analysing loads of different data in order to show us this is where we have likely big stacks of buy orders, or in the case of red UFOs, like we have here, big stacks of sell orders. So it's showing us where these orders are, and therefore where we have probability for price to go up from or go down from if it's our sell UFOs. Now, we have one extra element here. When the UFOs disappear again, we have one extra element here. We have multiple UFOs. So how do you know which one to pick? How do you know if it's the top one or if you should pick this one down here? Which of these have the highest probability? And this is where we're factoring in a third element here, which is our EMA back from our bigger time frame chart. So in this case, it was the daily chart that was where we have our auto climate. So that's the same chart that we're going to look for our EMA. Our EMA value is this number here. You can also see it up here if it's harder to tell from the different colored prices on the right hand side there. So the EMA value at the moment is 1.3613. Now, why is that important? So the EMA stands for exponential moving average. So we're actually seeing these a lot on COVID charts at the moment. You know, we're seeing each of what's happening every day and then like a rolling 7-day average or a rolling 14-day average, which is the line that moves through it. What a moving average does is it is collating the last X amount worth of data. In this case, it's a 9 EMA, so the last 9 points of data, the last 9 candles, and gives an average. Which means that whatever the price is going to dictate what the moving average is. So as the price moves, the moving average will move, because again, it's giving an average as to what those prices are. Now, why is that important? Why do we care? We care because other people care. There are, well, pretty much in every single platform, I don't know that there is any platform in the world that won't let you see a moving average. There are so many people that are using moving averages to give them signals on whether or not they buy or sell, to help them make decisions on whether or not they buy or sell. That's happening from the perspective of retail traders that just have this available to them on their platforms, but also hedge fund managers will also use the EMA to help them make decisions. So the usual use of an EMA, I'll just make this a little bit bigger, maybe a little bit easier to see, is that if price is above the EMA, like it is just now, and then comes down and hits the value that the EMA is currently at, that will spark buying and push it back up. Same is true if price is below the EMA, that if it comes up and hits that line, that it will go down from there. That's the theory. Again, as we can see, price has gone through this line many times, so it's not always true. But what we're trying to do here is combine two sets of probabilities. If we have buy orders that are being shown to us by our UFOs, which means we have probability there of buying coming into the market, and the EMA would also happen to be inside it, somewhere in there, then we also have likelihood that other people come in and buy for another reason. So we've got buy orders there already and extra buy orders, and we have a confirmed upwards climate, probability to the upside. So we're adding all of these odds in our favor to mean that by the time we put this trade on, we've got a much higher likelihood of it working. Again, not to say it's guaranteed that it will work, it's just a much higher likelihood because we've combined multiple odds in that favor. So let me know again, guys, if that makes sense, if I've lost you. If you're with me, let me know. Just give me a quick, yeah, it's all great, or no, not at all. Just let me know where you're at, so that I can explain more if I need to. But hopefully that makes sense, that we're using technology to show us where probabilities lie so that we can place trades that have high probability than others, which means we win more, right? That's what we want to do. So in this particular example, we actually don't have an opportunity. And why is that? Because this UFO that we see here does not coincide with the EMA value. The EMA value has changed there just drastically as prices come down. So the EMA value is 1.3601, which is here. Which means this line where the EMA is nowhere near a UFO. So we have probabilities there, but then also probabilities here. And they're not coinciding together, which means the areas don't have enough probability for us to say, yes, that's worth placing a trade. Now, for you guys, you might use UFOs in a different way, and you might decide that you just want to take the closest one, or you want to take the top two, or whatever you do. You can use this technology however you like. I'm explaining the methodology that we have that is based on trying to put as many probabilities together as possible. So for us, it doesn't matter that we have a UFO just there. If the EMA value isn't lining up, not enough probabilities, we're not going to take it. So we just move on. And no problem. We'd rather move on and be looking for opportunities where we do have higher probabilities than we would just place a trade for the sake of it. So hopefully that makes sense. Brilliant. I'm glad SB is following. Good. So we'll come back to the scanner here, and we'll just do the same thing we did before. Now, I can very quickly tell you that when it comes to the majors, if we just look down here on our daily climate, we obviously already looked at the pound dollar there and realized we didn't have an opportunity. These two are hopeful, and nothing else has a yellow box around it. So we're going to rule those out. Now, we could look at opportunities for slightly smaller time frames. So we could come back to that. But what I'm going to do first is come over to the minors. And why am I coming over to the minors? It's because, especially today is obviously the presidential inauguration day, and we can actually come across, if I just show you here, to FX Street. There we go. You can come across the FX Street, and I normally filter by the week ahead, so I can see what's going on in the week, and I filter by high impact news. We can use this to tell us whether or not we're going to have, or we're likely to have, more volatility in a particular currency pair. So today, at least for me, I think the presidential inauguration, especially with everything that's been happening recently, I wouldn't be surprised if that has a bit of an impact. So I'd probably rather keep away from the US dollar personally, myself today. That's not to say that it's not a good idea to trade it. And if you're on the right side of it, volatility can be your friend. You might use the high impact news coming out that could create high volatility to just help you manage your risk maybe a little bit tighter. That's a personal thing. For me, I think the presidential inauguration is probably likely to have more impact than the other stuff that we've got going on that are more just sort of habitual things and statements being released as they would be normally. So I'm going to try and keep away from the US dollar today. But again, that's a personal decision, not to say you guys have to follow suit. Okay, so let's come and look over here towards our, just going to get rid of that if I can. Okay, for some reason that's still there. We can't see the top of it, but that's okay. We've got enough opportunities. So these are our cross pairs, meaning these are currency pairs that don't contain a US dollar. So I'm going to look for our yellow boxes on the right-hand side, and then just double check that we also have that color box over here on the left-hand side. So this first one is ruled out because although it's a near sensible short, we've got a grey box there. So that tells us unconfirmed climate, no point looking. So we'll come down and let's have a look here. Aussie yen. We've got near sensible long, and we've got a nice blue box, so confirmed upwards climate. So we'll just go and have a look at that. This is a 240-minute time frame. So what that means is that we're like day swing trading. It's still a swing trade, but it might last maybe a few hours to a day or two, as opposed to a few days to a few weeks. So let's go and have a look at that. 240-minute chart for the Aussie yen. So make sure that you're looking at it on both time frames. On both charts even, that you're looking at the same thing. You don't want to be analysing one market on one side and analysing another market on the other side. So 240 minute on that side, which will mean we have a 21 minute on the right. Again, in terms of the timeframes, don't worry if you're not sure why we use those timeframes or what's going on. Doesn't matter so much. If you don't have a 21-minute time frame, use a 20. You want to be using a smaller time frame to get in, because that's where you want to be tighter with where your entry and stop is. Then you use the bigger time frame, which just helps you in general make a decision one way or the other. So we would use, if we've got a 240 minutes, so 4 hour on the left-hand side, then we would use a 21-minute there on the right-hand side. So let me know, guys, by the way, some of you might not have used TradingView before. This might be new technology. Some of you might use it all the time. So let me know if you're used to this, or if you'd like me to explain how you do the layouts or anything like that, I can do that as well. So again, I'll carry on and I'll keep an eye out for questions as they come in. So in this case, we have thick blue dot, confirmed upwards climate, probability to the upside. Lovely. We have our UFOs here on the right hand side, so we've got one here and one here. So again, if we're going to look to go long, we want to look for our buy UFOs, so our green UFOs, big stacks of buy orders. So we are seeing here that we have a UFO, the top one here, the numbers are 79.99 to 79.86. I'm just rounding there to the closest pip. Now, we have our EMA value highlighted here at 80.12, which is roughly here, which means, again, we have a situation where we don't have the probabilities lining up with each other. In the last example, we had the UFO above the EMA. At this example, we have the EMA above the UFO. Now, yes, as price moves down, the EMA may move with it and then end up within this UFO, but for the time being, it's not, so we'll just move on. So seeing there from SB new, I assume that means new to TradingView. I personally think TradingView is really easy to use. I find it really, really user-friendly. You can create free accounts with TradingView. You use it for charting. The good thing with TradingView is you can link it to any broker. Well, many brokers, not any broker, I shouldn't have said that. So if we go to here and do the brokers list, you can link TradingView to many different brokers. So if you have an account with one of these guys, Tiger Brokers is a new one there, you can just link it to this. So you can use the charts to do your analysis, use your UFOs, use your auto climate that maybe won't be available on the specific platform of the specific broker that you want to use. But you can do all your analysis on the chart here, connect it to the broker, and the trade will go through your broker. So you don't have to create new accounts and fund new accounts for TradingView. It's just there for you to be able to use the charts and link it to pretty much the majority of brokers that people would be using. So play about with it. Again, you can use a free account with TradingView. I would definitely recommend it. If not, the UFOs and the auto climate is available on TradeStation as well. But again, good thing with TradingView is it's available here and you can connect it to whoever you want. So nothing lined up there for the Aussie yen. No problem. We come back to the scanner. So again, we can see here that we have a near sensible long here for the New Zealand yen. So let's have a look at that. We might have a similar situation there because those guys are obviously quite correlated. New Zealand yen and New Zealand yen. And notice, by the way, as I'm putting in these currency pair symbols, you'll notice I can choose from down the side which broker I want to show me that data. So if you were, I'm picking FXCM just because it's the top one, but if you've got an Oanda account, then you might obviously want to be looking at the data that's coming through from Oanda. So the difference in spread, difference in the bid and ask might mean that the price is slightly different. So you obviously want to be placing trades that are more relevant to the prices you're getting from your broker. So again, you can just pick from the list which one you want to use. I'm just using FXCM because it's the top one, but of course you might do it slightly differently. So just looking quickly, looks like we are likely to have an opportunity here. So we have thick blue dot, confirmed upwards climate, probability to the upside, happy days. We have a UFO just here. The numbers are 74 point, I'm going to round that up, 03 to 73.97. Now our EMA value is 74.038. Now if we round that up, that would be 74.04. Now if we have our EMA value at 74.04, and we have our UFO starting at 74.03, technically, as it stands right now, these two things are not coinciding. So why am I saying we've got an opportunity? Because The EMA is a living, breathing, moving thing, right? That's not living, breathing, but it moves. So as price comes down towards this UFO, the EMA value, which actually, there we go, it's already moved. It's already moved. It's now on 74. 74 on the dot, pretty much. So it's already within that. So proves my point. The EMA value will move with price. So as price moves towards this UFO, the EMA value would have moved down and therefore making it more likely to be a valid trade. We now have the EMA value. Oh no, sorry, I was looking at the wrong number there. So it's still 74.04. But same concept applies. As price moves down, the EMA value is much more likely to actually be enveloped by this UFO. So this is the UFO that we're going to use to then place our trade. So what I like to do is just use some drawing tools here to help me. Now you might have noticed I've come over here and I've chosen fib retracement. Now you'll notice as I draw, if I sort of draw around that general area, that is not what you would expect a fib retracement to look like. Usually fibs will, if I just move this out of the way, if I click these, fibs will look something like that, or you'll have extensions or you'll have something like that that comes as default. So you have loads of little lines. I just unchecked all of them apart from 1 and 0 because all I'm using this Fibonacci retracement for is just a highlighting tool. I'm just using it as a drawing tool. I'm not using it for what it was intended to be used for. You can do it with horizontal lines or something else, or a box that you want to draw around the area, whatever you want to do. Again, for me, I use the fibs just because I like them as a drawing tool. So I've drawn them around that general area. Why would I draw the fibs on there if I've got my UFO? A couple of reasons. If price were to come down and fill these orders, bearing in mind UFO stands for unfilled orders. So if price comes down and fills these buy orders, the UFO is going to disappear because there's no longer unfilled buy orders there. The technology will know that and it's going to take it away. It's not going to show people that there are unfilled orders where there are no longer unfilled orders. So drawing on the chart allows me to, after the fact, be much more on top of what happened and visually see what's going on. So I'm just going to double click on these lines. I'm going to go to coordinates. That allows me to type over exactly where I want those lines to be. So how am I going to do this? Now I have my top line here on my top part of the UFO. This top band of my green UFO is 74.027. Just going to round that up to 74.03, so it's the closest pip. Now I'm going to add a couple of pips to that. Why am I going to add a couple of pips? Because the difference between the bid and the ask, the spread, can sometimes mean that when we're buying, we miss out on our entry sometimes by a couple of pips. So I'm just going to give myself that little bit extra room, and I'm going to type in here. So 74.03 was me rounding it up, and then add a couple of pips will be 74.05. So that's now going to be my entry value. This is the third question, being specific about exactly what my entry stops and targets are going to be. So in terms of my stop value, I'm going to use this bottom number here from the UFO. Now we're buying, so we're using the top number for the entry and the bottom number for the stop. If we were selling, then you just do the reverse. So here we have 73.97. So don't need to round it up or down. It's already at a round number. 73.97. I'm going to take away 5 pips there to give me a little bit of wiggle room on my stop, which means I'm going to make it 73.92. If I click OK, you'll notice those lines will move. There we go. Now, I'm just going to connect here, I guess, to paper trading so that I can see this on the side. There we go. So that's my entry value at the top there, this top black line with that value there, and this bottom black line is my stop value. So again, I've just added a couple of pips either side, or taken away 5 pips for my stop just to give me some wiggle room. Again, you might have different rules on that. You might do it as a percentage of ATR or a percentage of the value or whatever you do. For us, we're just giving it 5 pips wiggle room there for our stop. So I'm going to come over here. If I click buy, make sure I'm on limit, I can then type in what my entry value is, which in this case is 74.05. My stop loss, I just tick this little box and I'm going to type in the price, which in this case was 73.92. And what's really cool about TradingView as well, again, if you're new to it, what I like about it is it does maths for me, so I don't have to do it. It figures it out for myself. So what this has done is it's told me that's a 13 pip risk. So pips, the smallest movement, smallest increment of price in Forex, this is a 13 pip difference between my entry and my stop. if I was to trade 1,000 units of that, 1,000 lots, then I would be risking 130 US dollars. Now, what if I don't want to risk 130 US dollars? What if I only want to risk 50? I can just type in 50 in there and it's going to tell me how many units that is. I don't have to work that out, which is, I like that. Or you might say I want to risk a certain percentage of my account and you type that in. Now, I'm just going to say $50 because I'm going to do $50 on one, $50 on the other. I'm going to have two different targets, which means that the total risk for the trade will be $100. I'm doing that just because it's a nice, easy round number. For you guys, it's going to be all different numbers depending on your account size, how you feel about risk, whether you use percentages, whatever you do. We would say you should be risking no more than 2% of your account size per trade. Ideally, actually, it's going to be 1% or less than that. 2% will be if you're sort of risk hungry, shall we say, maybe very comfortable with that and maybe quite experienced as well. So normally it's going to be around 1%, but no more than 2% would be our recommendation. So we've got the difference between our entry and our stop. How does that help me when it comes to my targets? Now for us, we have two separate targets. Again, you guys can have different rules when it comes to placing your targets. Some people just do it at a set amount or distance away. Some people will do it at a particular point in price that will help them to decide that actually I should get out by them. For us, we like to have two for different reasons. So the first target we have is what we call our safety target. Now, safety target kind of clues in the name. Why do we have it? Because it brings us to safety as soon as possible. The safety target is always 1-to-1 away. So that means if I'm risking 13 pips in terms of this distance between my entry and stop, then I want to make 13 pips, which is the same distance again, to the upside. It's a 1-to-1 trade. So if I'm risking $50, I'll make $50. Now I do that so that if I have, let's just say I were to have a target all the way up here, and price came in and it hit my entry and then it moved off towards my target, didn't quite hit it, and then just comes back against me and stops me out. Well, if I took profit round about here for half of my position, then the worst that can possibly have happened at this point is that I break even because I made half my trade and then I lost half my trade. So I break even. I don't see price go in my favor and then come back and have me lose money. Again, there are different ways to do this. You can trail stops and things like that, but hopefully this makes sense as to why we do it this way and why we have a safety target and then a final target that's further away to get as much out of the trade as we can. So in this case, again, we can use TradingView to do the maths. I didn't need to go, what's the price value that's 13 pips above that? I just put 13 pips up here. It will show me with this number what the ratio is between those two things. My ratio is 1-to-1. That's what I want it to be. And it's then worked out what that price value is. Now, all I need to do is press buy. So my orders are now in. You'll get these little bubbles that come up that tell you your order's gone in. Again, if you were linked to a broker, then TradingView will send that order to your broker that will then put it out there into the world. So that's our safety target gone in. What I like to do here, by the way, is just draw a horizontal line. So I pick the horizontal ray and put that where my targets are. So I'm going to double click on that. Let's make it green because it's a target. So that's a nicer color, I think, for a target. And the price there was 74.80. I click OK. So again, I've got something drawn on the chart for easy visual reference later down the line. So great, that's my safety target. That takes me to safety as soon as possible. But obviously, we want to make as much out of the markets as we possibly can. But we also want to use probabilities to tell us where we're likely to be able to take it as far as it will go. So we're going to come over here to the left-hand side again, using our bigger time frame now for this analysis. Why are we using the bigger time frame? Because if on this time frame, which in this case is a 4-hour chart, we have a confirmed upwards climb, then price is moving to the upside on this time frame. It's moving to the upside on this time frame. It's probably unlikely to stop until it hits sell orders on its same time frame. It's less likely that sell orders on smaller time frames are going to stop it. Normally, the bigger the time frame, the stronger it is, whatever it is that's going on. So we're going to show our auto UFOs here on our left-hand side. So we want to find out where's the closest stack of sell orders on the bigger time frame that could stop this moving to the upside. Now, that's not to say, by the way, that it's definitely going to get there. We have our safety target to make sure that even if it only moves a little bit in our favor, we're protected. But if it does continue to move up, we want to take as much of it as we can. So we use an objective point in price, which is shown to us by our UFO, to give us that number. So this number here, 74.78, that's the bottom band of that stack of sell orders. So that's the first price where we would see sell orders starting to come in here. So we want to get out at that price, 74.78. That is now where our final target will be. So I'm going to come over here, click buy, do the exact same thing I did before. So we're going to put in our entry price, 74.05, our stop loss, 73.92. It's already remembered that for me. My profit target, this time I'm just going to type in what the number is. So 74.78. Now what that's now done is that's told me that if you were to do this trade and place it, I'm just going to once again put $50 in here, so it's the same. So half of the total risk on one of the trades, half the total risk on the other. I am risking one to make 5.62. In essence, this is the ratio here. It's a 5.62 to 1. Now, in reality, if we were to get into this trade and it was to go off and hit that target, we won't make overall 5.62 to 1 because we took half of the position off early. So we're not going to capture that entire move for the entire risk, but we do that for a reason, so that if it doesn't reach that number but does go in our favor a little bit, we're okay. So combined between the two, I'm just going to round that, let's say that's a 5 to 1. So 5 to 1 and a 1 to 1 together will make about a 3 to 1 each. So this trade becomes an average of a 3 to 1 if it were to hit both targets. We're just going to click buy, and now that's gone in. We now have, if I scroll this down, we now have our buy limit, our stop loss, and both profit targets, both with the same amount of risk involved. So we're going to put our horizontal line in there, again, just for easy reference. So it's 74.78, and that is a process start to finish. So we're using one big piece of technology, the auto climate, to make an easy decision. Do we buy or sell or do nothing? We then use another piece of technology to make it an easy decision as to where do we buy or sell if we're going to do one of the others, or one of those things. We use our EMA value to help this decision-making process be quicker and easier. Because if we have multiple choices of UFOs, the more confused we are as traders, the more likely we are to act inconsistently, maybe not trade at all, get overwhelmed. So we're using technology and probabilities at every stage to help make the decision process as easy as possible. Auto climate tells me whether I buy or sell. UFOs tell me where I should be looking to do that. And the EMA tells me which of those choices am I going to pick. So we then would figure out our entry and stop based around the values that we get from the UFOs. Our safety target is always 1 to 1 away. And our final target is based on the opposing or the rival UFO on that bigger time frame. Now, I know if you're completely new to trading in general, this might seem quite overwhelming. If you've been trading for a long time or following what we do in our sessions on YouTube or on FX Street, you might be very used to this and go, yeah, great, thanks, that will make sense. Wherever you're at with that, totally fine. If you have questions or you need to clarify things, you can come back and watch the recordings of these things. Or, like I said at the start, if you go to tradewithufos.com/Becky, fill in your free membership here, you can ask the question in this area here in public, so other people can see the answers to that questions, so that we're all learning from the questions that we all have. So coming back here, this was our New Zealand Japanese yen trade that we put in today. The next time that we come back on FX Street, we'll have a look at what happened to this. Did we get triggered in? Did we cancel it? Did we hit our targets? Did we hit our stop? We'll also come back and look at that Canadian Swiss that we were looking at the start. Just to let you know, for those of you that are completely new, Auto Climate as an app is free. So if you set up your free membership on this link, tradewithufos.com/Becky, fill in your name and email address, follow the steps, you'll then be able to download your Auto Climate app. So again, it's free on TradingView and it's free on TradeStation. The UFOs, depending on which platform you use, changes the cost. It's either $34 per month for TradingView or $89 per month for TradeStation. So again, some of you might just choose to use the Auto Climate, no problem, help you decide on that first question. Some of you might choose to use the UFOs as well. If you already have this technology, hopefully these kind of sessions help you understand the best uses of that technology to get the best out of them and get your highest probability when you're trading. So let me know, guys. We've come to the end of the session now. If you have any questions, if it did go over your head, let me know. If it made sense, let me know. Seen there from Cliff P. Just a beginner. You explain things like how Indian guys explain engineering on YouTube. It sounds so easy. I really like it. Okay, good. No one's ever told me that before, but thank you. I'll take that as a compliment. Thank you, Cliff. So I'll see you guys next time. Again, we have YouTube sessions. Some of the other instructors at Trade with UFOs also take those sessions. So follow those, participate in as much as you can. Email us if you need. Use the link there to ask questions in public. I'll be back next time. So I'll see you then. And happy trading, guys. Good luck.